What's going on, money lovers? Welcome back. Over the weekend, I had a revelation. The stonk gods came down to me and they said, Vincent, why would you own anything but QQQ? I checked out QQQ's performance, seeing that not even the S&P 500 could compete. I replied, well, gee whiz, I sure can't argue with those numbers. So I'm going to do a detailed breakdown of QQQ today, compare some of the key statistics with the S&P 500, and I'm going to outline 3 reasons why I think you'd be better off holding QQQ for the next decade than you would with holding an S&P 500 index. Now, as always, I am not a licensed financial advisor. This video is for educational and informational purposes only. Always consult a professional before making investment decisions. Blah, 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 yada, yada, yada. Don't forget to smash that subscribe button. 5, 4, 3, 2, 1. All right, great job, everyone. Without further ado, let's jump right into this. If we take a quick look at SPY here, which is a S&P 500 index, you see that it's got an expense ratio of 0.09%. If we take a look at its top 10 holdings, you see you've got FAMGA here, Apple, Microsoft, Amazon, Facebook, Google. You got some Berkshire, Johnson & Johnson, Procter & Gamble, and Nvidia. Now, if we compare that to the holdings of QQQ, now QQQ is also an index, but it tracks the Nasdaq top 100 or so companies. So as you can see, its expense ratio is 0.2. Top 10 holdings are very similar. You have these FAMGA stocks, but the key difference is you have much larger exposure. It's almost double than that of the S&P. Then you have Tesla, you've got Nvidia, PayPal, and Netflix. So QQQ gets you double the exposure to FAMGA stocks as SPY does. Now, just looking at these top 10 companies, which 10 would you bet on for the next 10 years? I'm definitely going with QQQ. You know, I'd want to have bigger exposure to these winners here. Now, if we compare the sector weightings, while the Nasdaq is largely made up of technology, it is not only technology, which is a common misconception, and I'll dive into some of the other holdings in a minute. But as you can see here, QQQ has almost 20% exposure to consumer cyclical companies, very little financial exposure. That's one of the key differences, as we'll see. Almost 5% consumer defensive, 6.5% healthcare, 20% communication, and the other major difference with SPY that you'll see is that technology comprises about 44% of this portfolio. If we compare that to SPY, as you can see here, they're much more diversified across the different sectors. 11% consumer cyclical, they've got a little over 12% financial services, a little bit of real estate, 7.5% consumer defensive, 14% healthcare, 11% comm, some energy, industrials exposure, and then technology is 24%, or roughly half that of QQQ. Now, if we compare the performance of these two funds, as you can see, for SPY or the S&P 500, year to date, it's up a little over 11%, and its 10-year average annual return is almost 13%, whereas QQQ, its year-to-date performance is almost 34%, and its 10-year performance is nearly at 20% on average. And if we just compare some of these, you can see the pattern here. Each year, if we just go all the way back to 2010, as you can see from this chart, QQQ has significantly outperformed the S&P over the last 10 years. Another thing to think about is you can make the argument that yes, with SPY, it may be the safer investment because you are more diversified, but play a little devil's advocate here. I could make the argument with QQQ, you're diversified, you're actually better off because you own the cream of the crop. You own the best companies and you have bigger weightings in them. FAMGA, these top companies here, aren't going anywhere but up. They're here to stay, and they're going to keep growing, in my opinion. And with SPY, you have smaller exposure to these big winners, and you own a lot of junky companies. You own 500 companies. A lot of them are in industries that are on their way out. By diversifying just for the sake of diversity, you end up diversifying. To paraphrase the great Peter Lynch, one of the most successful fund managers of all time. Don't take it from me. Listen to this short segment from an interview with the man himself.
Frankly, think it's a tragedy in America that the small investor has been convinced by the media, the print media, that they don't have a chance. Big institutions with all their computers and all their degrees and all their money have all the edges. And it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. And they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. Because if someone that can sit back and have their own opinion and know something about industry, this is a positive. It's not a negative. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
So why own 500 companies in the S&P 500 when you don't understand 400 of them, when you can own 100 of arguably the best companies that have the brightest future, like those that make up the top 100 companies of the Nasdaq? So my 3 major reasons as to why I'm buying QQQ. There's a history of major outperformance in the last 10 years of QQQ over the S&P, and I think this is a trend that will continue because the second reason, I believe the future is in tech. Who is going to outperform the technology industry in the next decade and how? How can any other industry possibly compete without itself becoming designated as a technology company? I think you're selling yourself short with owning SPY or a total market index fund, and the diversifying argument is invalidated. You're not really diversified. You just own smaller amounts of the winners and more of the losers, a lot more. So even if a company outside of those top 10 starts to do well, let's say in SPY, take a company that's way down the list and it comprises 0.02% of the index. So it goes up 100%. Okay, congrats. You just turned your 0.02% into a whopping 0.04% ownership of that company. So you could have 10 of those, and all it's going to take is 2 companies to not perform well, and it will totally negate all of those gains. So are you really diversifying properly if you're just owning smaller positions in lots of subpar companies? Or would you be better diversified owning a smaller amount of companies, but owning the best companies? Now, I've been playing devil's advocate a little bit today, but I really think this argument holds true. And it is interesting to point out the many non-tech holdings that comprise the Nasdaq 100. So obviously the majority is technology, but if you look, communication segment here, Facebook, Google, Comcast, T-Mobile, and then for consumer discretionary, it's interesting they have Amazon as a consumer discretionary company, but that's the other thing. A lot of these companies don't fall into one blanket sector, and that's the other interesting way that technology is expanding and changing the way the sectors have traditionally been laid out. For healthcare, I'm sure you've heard a few of these companies: Intuitive Surgical, Gilead, Biogen, Moderna. As far as consumer staples, a decent holding in PepsiCo, Costco. These are quality, excellent businesses. So you're probably wondering, what am I going to do now? I don't think I'm quite ready to completely sell out of the S&P 500, as I know the statistics say that in the long term, you can't outperform the market, and you are best off just, matching the market's return by owning an S&P index, let's say. But I do feel there's something to be said here about tech, and I'll definitely be adding a QQQ position because I do believe the future is technology, especially when you look ahead the next decade. I just don't see how any other industry is going to be able to grow as much, and especially when the world we live in, technology is advancing faster than ever before. I think a lot of these older companies are going to be getting left behind at a much quicker and widespread rate than we have ever seen before. I think there's a reason why QQQ, the Nasdaq 100, has so far outperformed the broader market over the last 10 years. And if you're bullish on tech, I can only see this trend continuing. I also see owning QQQ as a better alternative to buying into these huge companies like Amazon and dishing out over $3,000 per share, because with QQQ, I feel like I'm getting meaningful ownership over 10 to 13% in these great companies versus the S&P, where it's only, say, 4 to 5%, and it's being negated by so many lackluster companies that are going to drag it down. And one final point. If diversity is supposed to protect you and reduce your risk exposure, then why is it in the last 2 crises, having more diversity has left you worse off? Here's a look at how SPY performed from 2008 to 2010 in the financial crisis, and here's how QQQ, or the Nasdaq 100, performed. it far outperformed the broader market and had a much quicker recovery. And the same holds true in the current situation with the ongoing pandemic. So with all that being said, I feel like an investment in QQQ is a way to diversely invest in the companies of the future, whereas an investment in the S&P is an investment in the companies of the past. Do you agree or disagree? Let me know in the comments below. This is Vinny from the Investment Club, and I'll see you next time.